In our previous video on appraisal, we delved into how to use appraisal as a tool to obtain a fair settlement from insurance companies for property claims. Click on the link to check out that video. In states where laws are favorable, policyholders use appraisal to quickly and cheaply settle claims. But keep in mind, an award favorable to a policyholder just means that the insurance company was forced to pay what they should have paid on their own, and it cost the policyholder time and money. The dark side to insurance appraisal began when in recent years, many professional appraisers started seeing an influx of business. Carriers were systematically underpaying claims in new and novel ways. More and more policyholders had to turn to appraisal for fair settlement of their claims. If the insurance company isn't engaging, interacting, or negotiating with customers who have legitimate issues and complaints, the arena to resolve the dispute must turn elsewhere other than dealing directly with the insurance company.
You sent in photos, but those photos that came in on that were in black and white, okay? And we could not tell anything from the black and white thing.
At first, insurance companies weren't worried about appraisal. They even challenged policyholders to use appraisal. But appraisal became consistent with a hole in a dam. The carriers spent great amounts of money and time to hold back the flow of claim payments. But much to their surprise, policyholders found a way to get a fair shake. This video is about insurance company attempts to limit or eliminate appraisal in recent years. If you're a policyholder with a claim, this video is not intended to scare you away from the appraisal process. Far from it. It's far better to be prepared for the hurdles you'll face than to get lost in the process. Insurance companies have tried to avoid payment for covered damage since at least the 1990s, when a mega consulting firm advised a major insurance company to start treating its claims department more like a profit center, as opposed to how claims departments were previously viewed. The part of the insurance company that honored the promise to indemnify policyholders. Some background. An insurance loss ratio is the percentage of premium dollars, i.e. the money you pay to get insurance, that are paid out on claims. For example, if an insurance company collects $1 million of premiums and pays out $700,000 on claim payments, their loss ratio is $700,000 divided by $1 million, or 70%. The insurance industry as a whole declined from a loss ratio of approximately 70% in the early 1990s to just over 50% in the mid-2000s, which means the insurance industry as a whole was paying out significantly less on claims, even though it had experienced several recent major catastrophes in 2005. It took some time, but policyholders and their advocates started to see the value in the appraisal process by having success obtaining fair settlements. It started costing the carriers money. When COVID shutdowns began in 2020, the courts were not immune from shutdowns. Widespread court shutdowns happened in many states. A deluge of appraisal denials followed. The same insurance companies that were baiting their customers to use the appraisal process just a few years before were now using suspect reasoning to avoid the appraisal process. This particular dispute involved a disagreement on scope, which is appraisable in the state in which this appraisal occurred. The policyholder was forced to hire an attorney. It went to court, and the court agreed with the policyholder that this was indeed an appraisable matter. This particular case involved a dispute about scope, which the courts in the state determined was appraisable and part of the amount of loss. This claim should have gone to appraisal. The carrier refused, the policyholder hired attorneys, and it was settled before it went to appraisal. The policyholders in the previous examples had to wait months for the courts to open to get any relief. When the unfounded appraisal denials first started, the common reaction was,
"No problem. We will just get our trusty team of lawyers."
"Wait, the courts are closed." Oops. The carriers are dastardly, but they are creative. Many carriers realized there was no recourse for denying appraisals. The only recourse for policyholders would be to sue to compel appraisal. The worst outcome for the carriers is spending money on an attorney and then having to do what they were supposed to do in the first place, depending on the state. It's no secret that carriers will spend more money fighting a claim than what it would have just cost to pay the claim in the first place. Don't be mistaken, this is advertising. The advertising says, don't fight your insurance company or you will regret it. Take the example of Trent Lott, the former Senate Majority Leader in the United States Senate. He was forced to sue his insurance company when his house was destroyed by Hurricane Katrina in 2005. What better advertising than to make a powerful United States Senator look helpless? It was eventually settled out of court, but the message to the public was clear. Back to the COVID appraisal denials. Some appraisal professionals started to become suspicious. Immediately, and out of nowhere, carriers stopped participating in appraisal. And because the courts were closed, there was no recourse. Not at the time. A major carrier that had rarely fought the appraisal process slipped up. Appraisal requires a disagreement to be established. If there is no disagreement, it is not ripe for appraisal. A mistake was made on this appraisal demand. A disagreement had not yet been established, which is a requirement for the appraisal process. The insurance company would have been acting within its rights to deny the appraisal due to the lack of established disagreement. But instead of sending that letter, the insurance company sent a letter that stated that the items in dispute were not eligible for appraisal, except literally nothing had been disputed. The insurance company was sending the same appraisal denial form letter to all of its customers. Here are the voicemails left by their adjuster who realized their mistake. He knew the cat was out of the bag and was desperate to try to get an estimate from the policyholder before anyone else noticed.
Hi, Mr. Walters. My name is John. Reaching out to you in regards to an appraisal demand we've received for property addresses. Please give me a call back at your earliest convenience to discuss your letter of demand. My number is extension is 10. Hello, my name is John. Calling from in regards to a claim for you elicited the appraiser on their appraisal demands, and I wanted to go over a few things in regards to the appraisal process. Please call me back at my direct extension is 10. Hello, this is John calling from reaching out to you in regards to an appraisal demand we received with your name on it. Please call us back at my direct extension. Hi, Ed. I'm giving you a call from regards to the claim for Greg. I wanted to reach out to you last week. Had spoken. You're going to get with the contractor to send over an estimate for the scope of loss that also for showing a pricing disagreement. We have not received anything as of yet, and I need something as soon as possible in order to address your appraisal demand. Call me back.
As you can see, carriers were denying appraisal wholesale. As the world opened back up recently, appraisal denials have not subsided. Quite the opposite. The practice has spread. Why? It's a numbers game. If 100 claimants demand appraisal and you send a form letter to all 100 stating that their demand was inappropriate, a vast majority will quit right there. How many? It's hard to say for sure, but certainly policyholders with no guidance or in-depth knowledge of the property casualty insurance industry will stop without any further action. But even public adjusters, attorneys, and appraisers who can offer guidance as to the path forward cannot convince all policyholders to challenge carriers who wrongly deny appraisals. Let's say half of claimants who are initially denied appraisal decline to take any further steps. It's probably an extremely low estimate, but here's the math. If all 100 had gone to appraisal with a 90% rate of obtaining a fair outcome, and the average claim dispute is $15,000, then 100 times 15,000 times 90% equals a $1,350,000 payout. If all 100 claimants get form letters appearing to deny appraisal and only 50 take any further action, then the remaining 50 claimants times $15,000 average dispute times a 90% fair outcome rate equals a $675,000 payout. That cut the cost in half for the carrier. That's a $675,000 savings. If the carrier could keep his legal costs per claim under $13,500, then they saved money. And as discussed earlier, the carrier might be willing to spend more than $13,500 per claim to fight, to send a message. To summarize, insurance companies increase profits by underpaying claims. Policyholders and their advocates used appraisal more frequently. The requirement of independent third-party appraisers moved the discussion away from the mega consulting insurance company-centric playing field to an even playing field. The expected profits from massively underpaying claims were not realized, partly because of the increased use of appraisal by policyholders to get a fair shake. Carriers decided to take their ball and go home by refusing to participate in appraisal. The lack of oversight or penalties for violating policyholder rights has encouraged improper appraisal denial to flourish. The war is not over. The arms race continues. The next chapter is yet to be written.